Hello and welcome again. This is Islam Ahmad. I will be your lecturer today, and we will start our webinar by just reviewing the risk warning. Please take a minute to read the risk warning. It's written in Arabic and English. The risk warning states that trading in forex, CFDs, and other derivatives is highly speculative and carries a high level of risk. It's possible to lose all your capital. These products may not be suitable for everyone. This webinar will be recorded. You can find it on our website and also on our YouTube channel. So you will have more time to review the risk warning if you couldn't read it fully, but you have to take this risk warning into consideration. Okay, let's move on. So today's topic is the power of combined analysis. If you were with me in last two webinars, we had one about the technical analysis and one about the fundamental analysis. We explained everything about them. If you didn't attend, it's fine. I will review them quickly before we move on to the practical examples. Today, I will try to make a lot of practical examples because this subject need to be applied on the actual market. So traders often compare the difference between fundamental analysis and technical analysis. However, blending the two can have positive benefits, although there are no hard facts as to which style of analysis is better. Combining the two may lead to more definitive trade choices. This is simply means if you can use both, you will have better results than just using one of them. Okay, so today we will try to find out how to combine the two methods or the two schools of analysis, the fundamental and the technical. We will have practical examples, but let's start by reviewing the essence of each of them. Okay, so we'll start by defining technical analysis. We know that in financial markets, the study of past market data, primarily price action, to forecast future price movements. This is the definition of technical analysis. Okay, so there is three key principles of the theory of technical analysis. This is the stones on which it's built. Okay, price action discounts everything. This means that you only need to look to the chart to see the price action and you will know all the stories. This is the first thing, the first principle in the technical analysis. Second is price moving trend. So the theory indicate that price is not like randomly moving, it's actually moving in a trend, and we will now explain the trend briefly. So the third principle is history repeats itself. What happened in the past may happen in the future. We may see it again over and over. This three principle is the pyramid of the technical analysis. Price action discounts everything, price moves in trend, history repeats itself. This is the very basic principle on which we will do anything in the technical analysis and the indicators. So this is the trend as the technical analysis defined it. It's higher highs, as you can see. If you just let me use this laser pointer, you can see this is a higher high and this is a higher low. So the uptrend is actually this line, we do it by ourselves, we draw it by ourselves, but the market actually moving is up and down, up and down. But how we define an uptrend, it's making a higher high and higher lows. So the market should be an uptrend. This higher high should not be like in this level, it should be higher, and this low should not be in this level. When we are making higher highs and higher lows, this is the definition of an uptrend according to technical analysis, and the opposite in the opposite direction. If we have a downtrend, this will be lower highs and lower lows. As you can see, this high, this low, it should be lower. So if the market is in a range the lows and the highs are actually in the same range. This is also, we count it as a trend. We call it the range bound market. So it's either uptrend or downtrend or in the range. But at any time, the market always have a trend, uptrend or downtrend or a range. So let's move to fundamental analysis. So what is fundamental analysis in financial markets? Fundamental analysis is evaluating currency centric value by examining various economic indicators and news event. We call it the fair value. Okay, here we are speaking about currencies, about shares, about precious metals like gold. We are trying to find, to evaluate the fair value and to compare it with the actual market price, so we know if the market is overpricing or underpricing the share or the currency. So unlike technical analysis, which focus on the price, the patterns, the chart, fundamental analysis look at the broader economic picture. So to understand the fundamental analysis, we have to know that there is three main economic goals. Each economy has three goals. This is the country economy goals. They want to have max number of employment and stability, which means controlling inflation, and economic growth, which means growing the GDP. So this is because we know this, we know each economy want to achieve these goals. Based on that, we predict what will happen. So this is the what we call the business cycle. This is every economy, every market go through this. It starts with this expansion from a trough, go to a peak, and then go back to contraction. This is normal, this is healthy, happened every time. Now you might hear in the news that news is stating that the US economy may go to a recession. Okay, what they mean by recession is this stage, which has a very high number of unemployment rate, a very high number of unemployed, and also the very high interest rates. So they predict that we are now going to a recession, but until now it's not proved. But you have to understand that this has to be. We have to get some recession, but we try to make it like as fast as we can. We try to pass it. We try to decrease its effect upon the economy, but we have to have it. This is actually like breathing, like inhaling and exhaling. This is normal. This is how life works. This is how economy works. So based on our understanding of this business cycle, you have to know that the central banks doesn't let it happen by itself. They try to interfere. They try to do some procedures so they can protect the economy from the recession and stay for a very long time in expansion phase. So they use economic tools. For us, this is indicators. For us as traders trying to make profit, we use this as indicators, so we choose how we can trade. So the first and most important is interest rates. Actually, everything here is important, all the economic indicators, but they are correlated. They are all playing in the same symphony, but it starts always with the interest rate. This is the main focus, because central banks such as the Federal Reserve or the European Central Bank, they set interest rate that influence the currency value. So when it's a higher interest rate, this typically attract foreign investment, so it increases the demand for that currency, and the law of supply and demand, whenever the demand is high, this goes higher. So the interest rate, when it goes higher, it actually, not every time, but most of the time, it increases the value of the currency. So the second economic indicator we use is the inflation rate. So inflation affects purchasing power. Central bank may adjust interest rate to control inflation, so this impacts the currency strength. Meaning that inflation is when the prices are increasing. So for example, the Fed has a target of 2% inflation. Okay, They know there will be inflation, but they don't want the inflation to be above 2%. This is the target. So when they have this inflation, they try to adjust it by the interest rate. So when we see inflation rates going higher, before even the Fed go to increase the interest rate, we know that he's going to do it. So the traders start to buy this currency because of the inflation higher rates. So this is how it works. We will have more practical example, but just let's quickly go to other economic indicators. This is very important. The gross domestic product, the GDP. You will always hear this. The inflation, interest rates, GDP. This is all related. The GDP measures the country economic performance. So a growing GDP indicates a stronger economy, which can strengthen the currency. Okay, we're using all of this to try to find out a very strong economy, so it will be having a very strong currency, so we can buy it. Hopefully it will be going up and making profit for us. So the employment data, as I told you, everything here is related. The employment figures such as the non-farm payroll, the NFP and the US, this provide insights into economic health. So a higher employment usually strengthens the currency. At any time, if you have any questions, feel free to write me on the chat. I'm trying to go as fast as I can in this, so we have some practical examples. So the last economic indicator, actually, this is not fixed indicator, but there is geopolitical events. So political stability and like what's happening right now in the world, this Ukrainian-Russian war in the Middle East, we have this political stability and international relation, they can impact currency value. For example, as we see now, what's happening between Russia and Ukraine and the Middle East also, all this is affecting the prices of gold and all the major currencies. So this was about the fundamental indicators. We will quickly go to the types of chart. The chart is what we use to see the prices, and the basic form of it is the line chart. This is a simple chart that connects the closing prices of a set of period. For example, this is a 1 hour chart for the US dollar against the Japanese yen. How much you pay to get $1 for the Japanese yen. This is now connecting closing prices for the 1 hour. This is the line chart. This is the most basic. And also after that we have the bar charts. This have more data. Here this is the open price. Here this is the closing price. This is because it was a higher closing. This is an up candle. It's green. You can adjust this colors, but here it's green and red. Mostly it's green or red, white or black, whatever you want, but you have to like separate them so you can understand quickly what's the candle is telling you. So the candlestick is the most common. I think you would find it very helpful. This is like the lion bar, but the visual representative that it show a body to the candle between the open and the closing. For this is like this big red candle. It opened here and closed here. And this is the higher price. This is the lower price during this day. This is a daily chart of gold. So this is what we use to see the prices and know the moves. So when we have this chart, there is some patterns. According to technical analysis, as we discussed in the first slide, that history repeats itself. So there is some patterns, some shapes that when we see it, the market tend to behave in a certain way. So mainly you can say there is two types of pattern: reversal patterns and continuation patterns. Okay. Of course, we will not have time to discuss all, but we will discuss the most important. This is the head and shoulder pattern. This is a reversal pattern. Whenever you see this pattern, you expect by a very high percentage that the market will reverse. This is not an exact science, technical or fundamental, or trying to trade in this market. This is not exact science. This is like an art. So you use what you know to find the best way, the best trade, but there is no hard facts or 100% sure that the market will behave in this way. If you have like something giving you 60 or 70%, this is a very good probability to trade with this market. So head and shoulders, as you can see, the market go up until this moment, going down here. It made a higher high, very little higher high, but it failed to make a higher low. As you remember the definition of uptrend, it should be like this low should be like here, for example, but it couldn't. This high should be like here. It couldn't do this, and actually the next high was lower high. Because of this lower high, the price is going down and shaping the next shoulder. So as you can see, this is the shoulder, this is the head, this is the other shoulder. So we expect that when the neckline, we call this neckline. You see this line between this low and this low, we call it a neckline. When it's broken, we predict the market will go down for a distance. Mainly it will be like the as the measure from the neckline to the head. Let's move on. So there is another reversal pattern, which is the double bottom and double top. This is two, but you can combine both. You see both according to the trend. If it's a downtrend, you see it doing this lower low. It should be now lower, but this second one is not lower. Actually, it's the same level, and then the market go back to this. Here, this is the neckline. So when this neckline broke, we predict that the market will go up in reverse of the downtrend it was. And the same applies to an uptrend. This is an uptrend, so the market going up, here going down, failed to make a higher high. It was in the same level and go back again to the neckline. When broke the neckline, we predict the market will reverse. The head and shoulders and double top and double bottoms are the most important reversal patterns you can see in the market. We will have some practical example, but let's go to some continuation pattern. Flag is the most famous continuation patterns. It actually, when this is a downtrend, it move in a range for some time, so it shaped something like a flag. So when we predict that if this point, this shape, this range is broken, that it will go down. And if this is an uptrend, this is a shape. So we have this flag. We predict that the market will go up, continuing the uptrends. So this is the flag, mainly is a continuation pattern. We have also the triangle. Triangle is either ascending or descending. So if this is an uptrend, the market was trying to break this point, it couldn't, so it shaped this triangle. When it's break, we predict it will continue to go up, and we predict that the this move up, it will be as this area at this space. So as the descending triangle, it is going down, making this shape of triangle. Then we predict if this is broken, that the market will continue going down, and the market move should be as long as this space. There is a symmetrical triangle when it's not having this line for up or down. Actually, it's symmetrical like this. So in this one, we don't say it will go up or down. We say if it's broken from a point, from this point, it will go up. So we will wait for a confirmation for this line to be broken. So it will go up. If this one was broken, it will go down. So as you see, the these levels actually shape something we call support and resistance. Resistance is a price level where an uptrend can be expected to pause due to concentration of supply. The support level is the price level where downtrend can be expected to pause due to concentration of demand. So support and resistance is very important. We use it always to predict the market moves, and most of the time, I'm repeating, this is not exact science, but most of the time we respect these levels. This is when the support and resistance can reverse. So if a support is broken, this was a support. If it was broken and the market go to retest it, we think that it will be a resistance because it was broken as a support. So now it will be a resistance. And also the resistance, when it's broken, the price go up above the resistance, the market should go down and retest it, so it can be a support. Okay, so the technical indicators, this is a mathematical pattern driven from the historical data used by the technical traders or investors to predict the future prices and make trading decision. We will have the most common, the moving average. The moving average mainly is like a trend line. It's telling you the trend. For example, this is the gold 4 hours chart. So this is the 50 moving average. If it's 50, if this is a daily chart, this will be a 50-day. If it's 4 hour chart, each candle is 4 hours. So this is the 54 hour chart moving average. Above this, you are in uptrend, and under this, you are below this, you are in a downtrend, as you can see. So we can use this to identify the trend. We have RSI. RSI is mainly trying to find the overbuying and overselling area. Mainly 70 area is considered overbuying market and 30% oversold market. We'll have some practical example. It's like this is the US dollar against the Japanese yen. You'll see in this area it was oversold, in this area it was overbought. As you can see, the market actually started to move down from here. So predict from the RSI, if it's in this area, we are in an uptrend, that this is maybe not the best time to buy. This is the MACD, the moving average convergence divergence, a trend following momentum. This is giving you the relationship between two moving average. The main idea of the MACD, it's like the momentum. When a car, this is the example we always like to use. When a car is trying to stop or change direction, it will not stop in the same minute or the same second. It will slow down, then it will stop and go the other direction. This is what we use the MACD for. So we can see the momentum of the market, the acceleration. So when the market is slowing down, as you can see here, these bars, it's like slowing down. So if you can see here, the market actually started changing direction, but after it went down, it was like fading. So we use the MACD for this, and we will have some practical examples. This is the MACD divergence. When the MACD is making, okay, this is a downtrend, okay? When the MACD is making higher highs instead of lower lows. This is a low, this is a lower low. In a downtrend, this is now lower low, okay? This is a lower low than this one. But the MACD did not make a lower low. These lines should now be lower from this to this. Actually, what happened is a divergence. We call this the MACD divergence. This is the one of the most strongest. This is the strongest indication of MACD that there is a change in the direction. So if this market is going down, we predict that it will go up for some time because of this divergence. So this is the candlestick patterns. We have a lot of them. Mainly, this is, as we see here, the spinning tops. It's saying there is indecision. You should use the candlesticks as if it's telling you a story. If you can see my screen right now, this is what? This is a market open here, went up for some time, up until this one. It went down until this price, then it went in the same direction. It was up, okay? Green means it opened and closed above the opening price. The other candle did the same, went very high, went very low, then it's closed, but the closing of this one actually made us go back to the opening of this one. So this is indecision. The market cannot decide what's the story, what it will happen. Okay, there is the shooting star. If you can see here, this is if this in an uptrend, this is an indication of the market will change the direction. The doji also, if you can see, this is very common. This is indecision. But if you can see it in an uptrend, most commonly it will go down after this doji. Okay, so when you have something like this, the morning star, the market was going down and have this indecision and then go up, so the market most probably will change direction. Okay, this is the economic calendar from which we use we know the fundamentals from the economic calendar. We know the news, so you should always know at least you should know the timing of the news, because in this timing this will happen. This will make a lot of moves in the market. So we will recap. The key economic indicators are interest rate, inflation rate, the GDP, the employment data, and the geopolitical events. So in investing, fundamental and technical analysis serve as critical tools for those in the market. So fundamental analysis focus on financial statements, economic indicators to estimate an asset or currency intrinsic value, making it more suitable for long-term investment decisions. So mainly, fundamental can be used to make a very long decisions. Technical analysis examines shares or currency price moves and trend to identify investment opportunities, while fundamental analysis often criticized for being long-term. It's time-consuming. It's less effective. It's less effective maybe in short term, but in long term it's very effective. But technical analysis also criticized for looking less at the value, the real value of the share or the instrument. So we can use both. Fundamental analysis provide the insight into what to buy, while technical analysis tells you when to buy or sell. So ultimately, the choice depends on your trading style, investment horizon, and financial objective. Okay, so this is the very basic plan. Start with fundamental to identify the potential trend, then use technical analysis to identify entry points. Let winners ride using technical analysis, and then you cut loose also using technical tools and indicators. You can use risk management to plan and handle risk. So you follow up with fundamental indicators to predict any trend change. So please send me now if you have any questions. And while I wait for your question, I will go to some live examples. Okay. I will use the dollar yen. Okay. Someone asked me about the dollar yen. Okay. What happened today is, let's have a new chart. Okay. I'll give you the 1 minute chart. Okay. First of all, this move started with the news. We had the news today at 4:30 Dubai time, and this news was from the United States about the unemployment rate and many other news, but mainly the unemployment rate. Why this is important? Because we are waiting for the Fed to cut the interest rate, to decrease it. We are waiting for this. So when the data is coming and encouraging this cut, the dollar will decrease in value. When the data come and it's not, giving us, actually, the fundamentals say the Fed has to cut the rates. Okay, now the market know already that the Fed will cut the rates. Let me tell you, maybe this is the most important thing I would say today. If you forget everything, just remember this one. Market is not moving on the actual facts. Market is moving upon the predictions. What the markets think will happen tomorrow affect today's decisions. So what you are seeing in front of you in this live chart is actually representation of what the market is expecting to happen tomorrow. So when the market expects that the dollar will go up in value, you will see that the dollar is going up in value, not because something actually happened, but because the market predicts something will happen. That's it. Okay. So because the market now is predicting the Fed will cut the interest rate, but they are now trying to find out how much will this cut in times, how many times he will do it, and each cut, how much it will be. It will be 50 points or 25 points. So because of this data, of today's data, the market predicted that the US dollar will be more stronger because of the unemployment data happened today. Okay, this is fundamentally. Okay, let's see something technically. Okay, this candle here, the news came and it was very strong, okay, for the dollar. You can see this candle, very big candle. I want you to notice the MACD. Look to the chart and the MACD. You will see that the market is going up, as you can see here, but for the first minutes, the MACD was going up, then start to go down. This is, I remind you with the example of the car. This is like the car is slowing down. If you can see here, this is 1 minute chart. I'm trying to give you, this is live chart, dollar yen, 1 minute chart. This was actually happening in the market in the last 2 hours. So if you can see here, the market is going up, but the bars here is going down. This is the power of technical analysis, the technical indicators. It's not telling you to sell right now, but at least it's giving you an indication of what the market's momentum. So we have a news. This is fundamental. We understand it. We know that now the market should go up, but we can see now after this move, it's actually moving in a range right now, and we expect that the market expect this dollar to go down in value against the yen in the coming days, okay, because of the rate cut. What's happening fundamentally now is the Japanese, the Bank of Japan is increasing the interest rate. They made it 0.25 after like maybe more than 10 years of fixed interest rate. They finally decided to increase it, while at the same time the Fed is decreasing the interest rate. This is fundamentally giving you what? Giving you an indication that the dollar will be weaker against the yen. Also, there is, you can see here, this is the downtrend that the dollar against the yen took from the time the Fed announced that it will start cutting rates, interest rate, while the Bank of Japan starting to increase its interest rate. So this is fundamental. You use this information and then use the technical to take your decisions. So the main trend right now for the very long time, it should be downtrend, okay? Even if you want to buy this pair, the dollar against the yen, you should know that the big trend is a downtrend. We have been in like going up for some time, and actually this time of going up has also a fundamental facts backing it, because Bank of Japan announced that he will not continue increasing the interest rate if the market is very volatile. They need stable market, so they increase the interest rate. From this moment, the market went back to go up. So you have this fundamental information, but you can also see technicals. As I told you, you have this 1 minute. You can see here that there is a MACD fading. So now it's not the best time. If you want to buy, this is not the best time. If you want to sell, maybe you can find like this resistance. This is the market top. It was 149, around 30 something. Okay, so let's have this trade, for example. Now we sold. We will make our stop loss on the 149, let's say 35. This is above this candle. Okay, this is the high of the market. Let's predict that the market can go back to the same level it was. Let's not be very greedy. We can make it like here. So maybe make it 147 like this. Oh no, this is really greedy. We can just go higher like this. Yeah, this is around 100 pips of profit, take profit, and around 50 pips of stop loss. So for a question about dollar yen, this is now the trade I would go in. Okay, I repeat, this is not a recommendation, or I don't recommend you to do with this. But if you want to ask me about what should I do if I'm in your place, I would do this. I would have this stop loss and take profit. I would have you know, my risk management. I don't recommend to risk more than 2% of this trade or any trade. But if I am now in this market, I would do this. I would sell. I would make my stop loss above this swing high. And this was the area I expect to have some support. It was a resistance here. It was broken. So I expect the market will go and retest this area again. So for the question about dollar yen, this is my analysis. Okay. If you have any more questions. Okay, someone asked about gold. Of course, everybody wants to predict gold prices. Okay, let's move on to gold. Because of the political tension we have now in the world, in the Middle East, we are seeing that the gold is going up. This is daily chart. Actually, if you can see, the long-term gold is in all-time highs. Because of a lot of stuff, because of this political tension, and also because of the monetary policies of easing, you know, like they are actually simply printing money in all the world, all the countries, even in the US. So this is not backed by any actual gold or any other value. So when this happens, the gold will go up. So the combination of the political tension and also this decreasing value of all the fiat currencies, this leading gold to go up in all-time high. So we call it safe haven or value saving. If you have money and you fear of the future, you buy gold. This is the simple rule. Everybody know it. Okay. So actually, until this day, we still have the same rule. So we have a very tension political events. We have mainly printing money everywhere. So that's why gold will go up. In my opinion, the uptrend now is not in the strongest phase. So if you want to buy gold, maybe this is not the best time. I'm speaking about trading in the markets. But physical gold you can buy and keep it for 1 year from now. I expect this will go up in value, maybe to 2,700. If your question about physical gold, you can buy it from these prices and leave it for like a year. I expect to see the 2,700 very soon, maybe some months. But in the trading, like daily or even in a week or scalping, I don't see this is a very good prices to scalp. If you want scalp, I might go to sell, not to buy. This is a 30-minute chart. So you can see here, this is a resistance and this levels. So you can, this is also the last resistance. So yeah, maybe I would wait for some time to retest this area again around 2,470. If I'm lucky enough to see this price again, I would sell and I would put my stop loss here in 2,480. This is a $10 trade. This is like a scalping. This is not a long term. As I told you, long term, I expect gold to go up. Okay. So if there is any other questions. The euro. Okay, someone is asking about the euro. We still have this dollar effect. Dollar is decreasing in value against all currencies, even the euro. So this is an uptrend. I would buy, not sell this market. Okay, not like gold. I wouldn't sell this market. I would buy it. And for a very short term, I would go like here. This is a 30 minutes chart, so 10950 or like 45. This will be my stop loss if I go now from this area, and I would target this range. This will be a very short term trade. As I told you, we are now, if you are going to buy and hold, buy the euro from any price right now. I predict in the future it will go up for some time. But if you are just scalping, I think you can buy also. I wouldn't sell the euro right now. I would buy it, but I would not hold for a long time. I would just close it as soon as I can, because the market volatility these days are very strong. Actually, the euro was in range. You see, this is 4-hour chart. It went up, but it then went down for a very long time in this range. Now it went up again. Then today it go down because of the news. But in the long term, I think the uptrend will continue. As I told you, this is not an advice to buy or sell. Use what I'm telling you. Or actually, let me finish by this. Whenever you hear any advice, this is someone else's vision based on some facts, some fundamental and some technical. Don't use it like, okay, he said buy, then I will buy. No, just think about it. Think about how this decision was made, so you can make your own. The whole idea of today's webinar was like this. How did I say buy the euro or sell the dollar against the yen? I didn't do this like by just taking chances. I have some fundamental analysis and technical analysis. Does this guarantee 100% I will win each time? No, of course not. And if I win in like 6 times out of 10, I'll be more than happy. I would make money. Maybe you will not believe this, but this is the actual happening. I can make money even if I lose 6 times out of 10, and I only win 4. Only by the risk management and money management. I talked about this in the past. Maybe in the future you can go back to this webinars about risk management and money management. Okay, I think this would be it for today. If there is any more questions, if not, I would just end this session. Please join us in the coming sessions. We will do these webinars each Thursday, and we'll be more than happy to see you again. If you have any question, feel free to send me. And also, we will have an email after this session. You will have my contact number. You can send me if you have any question. So thank you for your time, and I hope this was useful for you. This was Islam Ahmad, and hopefully we will meet very soon. Thank you and goodbye. I will end this session now.